Hi there! Welcome to Quantum Wallet. If you've ever wondered how to grow your money, achieve financial independence, or simply make your savings work harder for you, you're in the right place. Did you know that nearly 58% of Americans own stocks? Let's help you join them. Today, we're diving into the exciting world of investing in the stock market, a topic that might seem complex at first, but is incredibly rewarding once you understand the basics. Here's a quick question for you. Have you ever thought about where your money goes when it's just sitting in your bank account? If you're not investing, you could be missing out on the chance to grow your wealth exponentially. Stick around because by the end of this video, you'll know exactly how to take that first step into the world of investing. Here's what we'll cover today: what stocks are and why they matter in the financial market, the concept of ownership and how it works when you invest in a company, and finally, some practical tips to help you take your first steps into investing with confidence. Understanding stocks. A stock represents a share in the ownership of a company. When you buy a stock, you're essentially purchasing a small piece of that company. Think of it like this. Imagine a company is like a giant pizza. Each slice represents a share of the company. Now picture owning a slice of Apple or Amazon. That's what it means to own stock in a company. Each slice represents a share of the company. When you own one or more slices, you own a portion of that pizza. Now, why do companies sell stocks? Companies issue stocks as a way to raise money. For example, Tesla raised billions of dollars through stock offerings to fund its expansion and innovative projects. By issuing stocks, companies can grow without taking on heavy debt, while giving investors an opportunity to share in their success. This capital can be used for things like expanding their business, launching new products, or paying off debt. In return, investors like you and me get a chance to benefit from the company's success. When a company performs well, its stock price usually goes up, and as a shareholder, you benefit from that increase in value. You might also earn dividends, which are a portion of the company's profits paid out to shareholders. It's important to understand that investing in stocks is not just about buying and selling. It's about becoming a part owner in a company and participating in its journey. This is what makes the stock market such a powerful tool for building wealth over time. Steps to start investing. It might feel overwhelming at first, but breaking it down into simple steps can make it much more manageable. Why are you investing? Is it for retirement, like contributing to a 401k? Building an emergency fund, or saving for a big purchase? Having specific, tangible goals makes it easier to create a roadmap for your investments. Ask yourself, why are you investing? Is it for retirement, buying a home, funding education, or something else? Having a clear purpose will help you decide on the right strategy and timeline for your investments. Your goals will also determine whether you're looking for short-term gains or long-term growth. Remember, investing is a journey, and knowing your destination makes the path much clearer. Step 2 is understanding your risk tolerance. This refers to how much risk you're willing to take with your money. Are you comfortable with the ups and downs of the stock market, or do you prefer a more stable approach? Your age, financial situation, and personality all play a role in determining your risk tolerance. For example, younger investors often have a higher risk tolerance because they have more time to recover from market downturns. Step 3. Choose a brokerage account. Next, you'll need to choose a brokerage account. A brokerage is like a bridge that connects you to the stock market. There are many online platforms available, and the best one for you depends on factors like fees, ease of use, and available features. Look for a platform that offers educational resources, low fees, and a user-friendly interface. Some popular options include Robinhood, Fidelity, or Charles Schwab. These platforms cater to different needs, from beginner-friendly interfaces to advanced tools for seasoned investors. Step 4. Diversify your portfolio. Diversification is a key principle of investing. Common U.S. investment vehicles like ETFs or index funds, such as the S&P 500 ETF, make diversification easier by allowing you to invest in a wide range of companies with a single purchase. It means spreading your money across different types of investments to reduce risk. Think of it as not putting all your eggs in one basket. For example, you might invest in a mix of large companies, small startups, international markets, and even bonds. This way, if one investment doesn't perform well, others might balance it out. Step 5. Stay informed. Finally, ongoing education is crucial. The stock market is dynamic, and staying informed will help you make better decisions. Follow reputable financial news sources such as CNBC, Bloomberg, or the Wall Street Journal, read books on investing, and consider joining investment communities to learn from others. Remember, investing is a skill that improves over time. The more you learn, the more confident you'll feel about your decisions. Practical tips for beginners. Before we wrap up, let me share some practical tips that every beginner should know. These tips will help you avoid common pitfalls and set yourself up for success. Tip number 1, start small. First, start small. You don't need a lot of money to begin investing. Many platforms allow you to start with as little as $5 or $10. The key is to get started and build confidence over time. Starting small also helps you learn without the fear of losing a significant amount of money. Tip number 2, avoid emotional decisions. Next, avoid making emotional decisions. The stock market can be volatile and it's easy to panic when prices drop. Remember, investing is a long-term game. Stick to your plan and avoid reacting to short-term fluctuations. Tip number 3, automate your investments. Another great tip is to automate your investments. Many platforms allow you to set up automatic contributions to your investment account. This not only makes investing easier, but also ensures you're consistently building your portfolio. Tip number 4, reinvest dividends. Reinvesting dividends is another powerful strategy. Instead of cashing out your dividends, use them to buy more shares. Over time, this can significantly boost your returns thanks to the power of compounding. Finally, remember that investing is a marathon, not a sprint. Patience and consistency are your best friends. Thanks for watching. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more tips on building your financial future. Now it's time to take that first step and start your investing journey. See you in the next video.